Hey, Greg. How you doing, mate?
G'day, Woods. I'm all right. How are you?
Not too bad. Not too bad. Well, it seems like the whole world has lost its mind again. Obviously, with the news flow that war is an absolutely terrible thing, and the events unfolding in Ukraine are extremely disturbing to watch, no doubt. And it's also going to have many people really worried. I mean, every major news headline is focused on it, and many people will be clearly worried as a result, not least because of the market reaction. I mean, just yesterday afternoon, we were talking. I was sort of back and forth about what we're going to discuss in Insider today. Stocks were crashing, gold was rallying, so was the price of oil. And so we decided, rather than me write the Insider, which annoyingly I kind of got ahead of myself for once, I had something prepared. I thought we should probably sit down and just address the events, because they're pretty all over the place, and perhaps rightly, but we'll discuss that. But not to follow the mainstream news flow, but perhaps I thought we could try and attempt to unpick a little about what really might be going on from an investment and portfolio perspective, so that we can reassure readers, really, because markets don't stop. And just like anything that takes the world's attention, invariably there's something else going on. And lo and behold, I look at the markets just this morning and it's still really early, and it's almost the reverse of last night. Stocks are coming back, and the safety trade, gold, is selling off, and so is oil. And also the one thing that hasn't abated is inflation. That's still raging in the background. So this is not a discussion to try and unpick the geopolitics at play or report on what everyone else is reporting on, from Fox to CNN to the ABC and the BBC. And it's not our job really here at Fat Tail Investment Research to add to that noise. And actually next week, we've got a really detailed conversation with Jim Rickards lined up to get the real story there and cut through that noise. But I thought we could have a conversation today to talk about what really should investors be looking at times like this. What do you say?
Yeah, look, I think it's a really, really good point. And you mentioned the Insider that you wrote last week, which was a really, really good piece, and we got a lot of good feedback from it. And I think that's something that you're going to be talking about further in the weeks ahead. But, essentially the idea behind that is that, we're not particularly good investors as human beings, and we tend to overreact or react emotionally to a lot of events. And, we saw that yesterday. And I guess one of the points that I'd like to make firstly is, as you said, war is a terrible thing, but we're not here to moralize about the war. We're here to try to help investors understand the effects of these things on the stock market and on their investments, and how they should think about it. So if you're a student of history, you know that one of the adages is that, when there's blood on the streets or the sound of cannons, that old quotes from Rothschilds back from the Napoleonic Wars, is that's the time to buy. Yet yesterday it was outright panic and everyone was selling. And I actually put out a tweet. I don't really tweet too much, but I put out a tweet yesterday just saying, with a snapshot of the top 10 stocks on the ASX 200 in the biggest losers. And I said, there's blood in the streets. What should you be doing? And my implication was certainly not selling and joining the rest of the herd, because when that happens, that there's a lot of bad news in the price. There's outright panic, and the markets have been leading up to this moment for quite some time, and this whole geopolitical trade has been on for a good couple of weeks now. Oil is probably certainly overnight at $100 a barrel was well ahead of itself. Gold got ahead of itself, hitting up to, towards, I think, $1,960 US an ounce. At that price, you can just tell by the move and the way the market was moving, there was a lot of panic and a lot of just, how do I protect myself from this invasion? Every major news organization was leading with Russia has invaded Ukraine.
Yep.
When news hits the headlines in such a way, it is always in the price. And that's what I guess as a rational investor, you need to try to understand. So yesterday, I really tried not to read too much about it. I tried not to read too many headlines. I looked at the headlines and said, well, that's in the price. The VIX index which is the I guess the fear or the volatility index, that's spiked up to around 30 overnight or just before the session started, which again indicates there's a lot of fear in the market. So I had no idea how the markets were going to respond overnight or today. But clearly, my view was you shouldn't be joining in the panic at this point, because that's almost when the euphoria of panic hits its peak, and it's probably the worst time to sell. Now, I guess in saying that, it's not all about the Russia-Ukraine situation. The underlying drivers of the market over the past few months, and Murray and I have been talking about this in Insider and to our Alliance subscribers, that the market has just been overvalued. And when you go into a monetary tightening phase, the market is going to struggle. So this is just another layer of risk that has gone on top of that. And the underlying theme of the Fed having to tighten because of inflationary pressures throughout the world, that hasn't gone away. So what, I guess in the very short term, you'll probably see a relief rally. And, we're recording this quite early on Friday morning, but we've already seen the NASDAQ rally overnight, 2.5%.
Yeah, it's incredible. Yeah.
Oil's come off its highs. Gold's well off its highs. When I last checked, it was trading down about $18.80 an ounce. So a lot of this sort of fear, war premium is coming out of these trades very, very quickly. But the underlying problem for the market, if I call it a problem or challenges, is that the Fed still has to tighten. There's still inflationary pressures. And this war has just exacerbated those. Russia is a very big supplier of some crucial commodities in the world, including wheat and oil. So that's going to put pressure on these prices that'll feed through into consumer price inflation in the months down the track. We've had very big consumer price readings, 40-year highs, 7.5% in the US. That's become a political problem. So even though the Fed might want to, look at this conflict and say, look, we probably need to take it easy on the tightening front, there are political considerations where the US government, will be having quiet conversations with Jerome Powell saying, we want to get rid of this inflation. We've got midterm elections coming up later this year. This inflation problem is the number one problem. If you look at surveys of consumers in the US, it's the number one problem. We need to get rid of this. So yes, there's a lot of noise around Russia and Ukraine at the moment. Could it escalate into something more? Sure. I mean, I'm not a geopolitical strategist, and as you said, we'll talk to Jim Rickards about that next week and get that out to viewers. But I think you just need to be rational about this. And the other point I'd make is that we've just gone through reporting season in Australia. A lot of the reports have been pretty solid. The earnings are quite good. Yes, we might be going into a different environment in the next 6 to 12 months where you've got potentially rising interest rates. You're not going to have the fiscal stimulus you've had. I just filled up my car yesterday. There's definitely an oil tax going on.
It's amazing how quickly they raise petrol prices.
Exactly. It happens. Yeah. It happens very quickly. So, that's another tax on consumption. So there's going to be some headwinds. But, also you've got the reopening of the economies post, all this COVID stuff. So there are some tailwinds as well in certain sectors. So you need to try to rationalize the situation, not get too influenced by just the noise. As you said, there's so much noise around when you get this and everyone's got an opinion, and the best option is just to turn off that noise and turn off opinions, which, by the way, I'm not giving an opinion on the Russian situation today. I'm trying to rationally stand back and look at markets, look at valuations, look at prices, and then make a decision there. If you're a long-term investor, I don't think there's a lot to be concerned about, to be honest. Yes, we're going through some challenging periods, but that's just how markets work. We've had a very big run up from 2020 to the peak last year. It's not unusual for markets to give some of that back in a broader secular bull market.
There is a bit of parallel with March 2020, right? The fear was palpable back then, but if you were to stand back from a rational perspective, at the time it felt perhaps there was a sense of it. Well, if you look at all the news flow yesterday. There's that same sense, and it's easy to get caught up in it. But the message that we just want to say as investors, that's the worst thing you can do, basically. And look what happened from April 2020. You wouldn't have predicted that.
Absolutely.
You wouldn't have predicted it. But if you stood back and were rational about the situation, you probably wouldn't have done anything you regretted later.
Well, I guess the point is, if you would have joined in the panic, and just responded to falling share prices without even thinking about what the future held, what those valuations, because the market priced in very, very quickly a shutdown economy. So all of a sudden, these prices were gone from normal operating economic environment to the economy shut down with no visibility on when it's going to open. So probability, you sort of say, look, there's a lot of uncertainty here, but again, headlines, and this is the important takeaway. When you see something splashed across every newspaper in the country and every major news bulletin,
and they're all saying largely the same story.
It is in the price. So you don't really need to know anything more than the news in the headlines is priced into stock prices. So if you would have joined in the panic and sold in March, April 2020, you would have kicked yourself later. So it's just a matter of trying to, make sure that you separate yourself from the emotion and try and think rationally. And that's a really hard thing to do. I'm not saying it's easy at all, but if you're aware of these sorts of things, then it can make it a bit easier.
Kind of goes back to my email last week in Insider. It was amazing. Sometimes we write to people, and yourself and we have access to the Insider email box, and sometimes we go weeks, we don't get any response. And sometimes you write an email, which I wasn't expecting to have much of an impact, but we got loads of responses from that. And it was just a key point. You got to read, criticize, and you got to learn. If you just
think critically,
if you only just buy whatever an investment it is, if you just buy it without understanding why you're buying it or taking the time, and you just do it on a stock tip, you're probably not going to be mentally equipped to cope with market reactions like we saw yesterday.
Absolutely. There's just countless examples of that happening. And, the reason why people panic is because they don't actually know why they're owning something in the first place. So if you have a sound understanding of why you bought something, what you think the future holds, a reasonable understanding of the valuation and whether you think it's appropriate for the future outlook, if you've got no idea of those things, then your snap reaction when the fear hits is that you're going to get rid of that uncertainty, because it unloads the uncertainty off your conscience, and then you feel like you can breathe easy again. When you're holding something in your portfolio that you don't really know why you're holding it for, that's a recipe for panic and wrong decisions.
Which is kind of the opposite to what we're doing with the model portfolio for Alliance members. I mean, back when we launched it in November, there was a 30% cash allocation across certain sectors, which have done very well, by the way, compared to the market. But that was an irrational look at the market at the time. We launched it just so happened to be at all-time highs. That's why you and Murray decided to hold off on allocating much of that cash allocation. And that was a rational way to look at it, and it's paid off, right?
Yeah, I mean, that was just not being influenced by mandates. I mean, a lot of fund managers have to be fully invested, or they might have a mandate where their cash levels can only be, say, 5%. There's very few fund managers that have the freedom to have whatever cash levels they want. We just said, look, stocks are at all-time highs. The Fed's clearly in a tightening phase. You've got fiscal policy that's not going to deliver the same sort of stimulus that it has over the past couple of years. And you've got rising energy prices, which are going to act as another headwind. So, there were 3 headwinds on stocks when they were at all-time highs. So it didn't make a lot of sense to go to be fully invested. Now, the challenge with that is when and how do you deploy that 70%? Because I think one of the things that you have to be conscious of is that, yes, interest rates might be going up, but I don't think they're going to go up a lot. And I don't think cash is going to deliver you a decent return if you're planning for your retirement. So the good news is that the Aussie economy or the Aussie stock market still has a lot of reasonably priced stocks out there when you compare them to what you can get in cash. Now, cash has certainly benefited investors over the past 6 months. The ASX 200 peaked in about mid-August last year. So it's been, in a sideways trend for 6 months, and then it's sort of broken down early in this year. So we're off from the highs. So holding cash was a good short-term move, but longer term, it's not generally the best place to hold your money. So we're certainly cognizant of the fact that we've got 70% in cash that we don't need to hold long term. certainly guided by Murray's charts and his methodology of when he sees the downward pressure subsiding, waiting for buy signals and things like that. But our view is that at the moment, you're getting a bounce based on this relief rally, which often happens after the headlines hit.
Yep.
Every bit of negative news is priced in, then you get the bounce from that. But as I said, once the dust clears on that story, we're going to go back to how much the Fed's going to tighten. And coming up in mid-March, we've got the Fed meeting. And the question is whether they're going to move 50 basis points or 25 and how many after that. So it'll be back to all eyes on the Fed and the monetary tightening situation in the US.
So just a question on that. Part of your what was your thesis called with your investment letter?
The Life at Zero.
Life at Zero. Sorry, that was it. So part of that thesis was that in the Fed can say they're going to tighten, but I remember you saying that you don't know what the future might hold, but if there's a market panic of some sort, could it be the Ukraine crisis? I don't know. But you said that very quickly the Fed could come back to and abandon their plans to tighten. Do you think that's a possibility, or do you think inflation is just too far ahead for them to steer off course now?
I certainly think they'll start a tightening phase in March. The question is how far it will go. And if you look at the way that the credit markets or the bond market is reacting to all this, at the short end of the curve. So if we look at, say, 1 year and 2 year bonds, that's moving up quite high. But the longer end of the curve, which is a 10-year bond yield, that's still under 2% in the US. So despite 7.5% inflation readings, the long-term 10-year bond yield is under 2%. So the long end of the bond market is saying that rising interest rates, which the short end is responding to, is going to cause a slowdown and is going to cause inflation to subside and will probably lead to the Fed not tightening as much as the market's probably currently anticipating. So in answer to your question, the Life at Zero thesis was about we have got so much debt in the global economy that even if the central banks need to or want to, they'll be hamstrung by how much they can raise interest rates. And yes, inflation is a problem at the moment. And when it becomes a political problem, the Fed is going to be more concerned about raising interest rates and sacrificing the stock market to kill that inflation and make sure that it's not as a bigger political problem. So I think the equity market has always said the Fed's got our back and the Fed's on our side. But I think this year that's going to probably pose a few problems. And until the Fed sees inflation getting back under control, it's probably going to continue to raise rates. And my contention is that could well put the economy into recession. You're already seeing the yield curve shrink. And when the yield curve shrinks and inverts, it is always a sign of a recession. It hasn't inverted yet, but it's actually getting close. So, there are signs down the track that this Fed tightening is going to cause a recession. And I think that's the biggest story for stock markets, right? So, and going back to what we're doing with cash and what you should be looking to do with your portfolio, that's when you should be looking to ease back into the market when things are looking quite grim, when the Fed's tightening, because at some point they're going to unwind that and they're going to go back to, look, we've got inflation's done, we're done with our easing, and that'll put a bid back up under stocks. Because if cash rates are very low, bond yields remain low, it's stocks that have good earnings, that are generating a decent dividend, they will come back into favor and they should do quite well. So I'm not overly panicked. I see this as a bear market, which you get in stock markets. We just haven't had one for a while. We had that massive.
You need them, right? You need them.
Well, I mean, it's just a feature of markets. Okay, so I don't think it's anything to worry about. When there's like situations like a 2008 brewing, which there was some signs of that for a good couple of years beforehand, with the huge build up in property markets and that sort of stuff. That's when you should really, really start to worry. And I know there's a lot of people saying that this is a massive asset bubble and we're going to go through a 2008 style crash, but I don't think that's. I think that's a really low probability event. And when we're talking about the future, you really don't know what the future holds. So you've got to sort of deal in probabilities. I think to sit in cash waiting for a crash or a 2008 type event is a low probability play. So I just think that, you know, we're going to get some good buying opportunities this year if the Fed continues to tighten, and investors should do well if they take advantage of them.
Cool. Well, we'll leave it there today, Greg. It was just really a video to just try and keep people grounded in their view, and don't get too caught up in the news, as worrying as, you know, any potential war, like you said at the start, it's a terrible thing. But as investors, you got to step back a little bit. Don't panic, because that's probably the worst thing you can do, right? And I think next week what we will do, while we don't want to get caught up in the mainstream headlines, but the fact is a lot of our readers will be looking at those and feeling anxious and that kind of thing. So what we're going to look to do next week is perhaps have a few more of these conversations with different editors, and we're going to end the week with Jim Rickards, who is our man to go to with geopolitics, and he actually talked about this possibility back in October in his monthly, I think it was his October edition. He talked about the possibility of the tension between Ukraine and Russia happening, and he tends to be on the button with those things. So lots of discussions to come next week. Have you got a final message for everyone, Greg, for today? I know there's probably, this story is going to keep going, and it's going to keep going over the weekend, and it's probably going to be updated every minute. But just give a final message from your point of view, mate.
Yeah, look, if you're worried about your portfolio, all I would say is if it's in the news, it's in the price. So you can't worry about stuff that's already hit the headlines, and look at the reaction of the market to the news. And if the market reacts positively on bad news, then obviously that's a sign that, you know, all the bad news is in the price for the time being. So just try to rationalize things, try to put things into perspective, and don't panic. The time to panic is before everyone else, and that time's passed at the moment. So cool.
Yeah. All right, thanks, Greg, and thanks for tuning in, everybody. Look out for the stuff next week, and I believe if you want to head over to our YouTube channel, it's Fat Tail Investment Research. You should find us. Give us a follow. We're going to post some content next week just to cover these events from an investment perspective. Thanks so much, and we'll catch you very soon. Cheers.
See you guys.